Kelly Evans explains the tariff math, why inflation is low despite high tariffs. A jaw-dropping tariff conundrum is unfolding, and it might not be what you expect. Despite witnessing massive tariff revenues, flat inflation rates, and a more robust economy, there seems to be an underlying puzzle that has everyone talking. The basic expectation is clear. U.S. companies already facing over $100 billion in tariff costs have to either pass these additional expenses to their customers or absorb them through reduced profit margins. This would typically result in persistent inflation or lead companies to cut back on hiring and possibly even initiate layoffs. And yet, neither of these outcomes has emerged. So what is really driving this unexpected scenario? That's where it gets controversial. On a recent segment of CNBC's Power Lunch, I discussed this very issue with Treasury advisor Joe LaVorgna. Our conversation highlighted that while conventional theory would have predicted a more inflationary effect from such high tariffs, the answer seems to lie with foreign exporters swiftly adjusting their pricing strategies. For instance, Japanese automakers have reportedly reduced their prices by 19% for vehicles bound for North America in June. Similarly, China's factory prices dropped by 3.6% last month, a decline noted as the steepest in 2 years. To put this into perspective, imagine an import that cost $1,000 last year and now faces a 20% tariff. If the exporter then cuts his price even further, it results in generating tariff revenue while actually lowering the price paid by the end consumer, all without pressuring the importer's profit margins. This example, although somewhat extreme, illuminates the many subtle adjustments happening behind the scenes. According to estimates from Goldman Sachs, who themselves were surprised by the relatively muted impact, foreign exporters have absorbed about 20% of the tariff expenses so far. The remaining costs are split between businesses and consumers, but notably, less of the burden has been passed on to consumers compared to what happened during the first Trump administration. Initially, U.S. companies bore most of the tariff-related impact, which led to market jitters in April when the news first broke. However, over time, these companies have shifted from absorbing the full cost to gradually transferring roughly 40% of the tariff burden to consumers by the third month. Goldman Sachs anticipates that if the pass-through rate climbs to an estimated 50 to 60%, the core personal consumption expenditures, PCE, price index could rise to about 3.3% by December, up from 2.7% in May. This raises a critical point. Even though we might eventually face a stagflationary scenario driven by tariffs, for now their effect has been widely distributed across various players, foreign exporters, domestic businesses, consumers, and even the currency markets, diluting the expected negative impact. As Treasury advisor Joe LaVorgna boldly stated, tariffs are not inflationary. They'll be absorbed in foreign profit margins. This statement challenges the conventional wisdom and poses a big question for market optimists, Federal Reserve watchers, and the broader U.S. economic landscape. Will the coming months confirm that these tariff costs are effectively mitigated, or is there an undercurrent that could disrupt our economic stability? What do you think? Are tariffs secretly cushioning our economy, or is there more to this story that most are missing? Share your thoughts and join the debate. See you at 1 p.m. Kelly Evans, co-host of CNBC's Power Lunch. Follow me on Twitter at KellyCNBC and Instagram at RealKellyEvans. GM loses $1.9 billion as tariffs cost auto industry billions. Will car prices skyrocket? When it comes to the impact of tariffs on businesses, here's the hard truth. U.S. companies are feeling the brunt of these levies, but for now, they're shouldering the costs without passing them directly to consumers. That might sound like a win for buyers in the short term, but this strategy is far from sustainable. The big question is, how long can companies keep absorbing these costs before prices skyrocket? And this is the part most people miss. What happens next could reshape entire industries. Tariffs imposed by the Trump administration have begun to weigh heavily on American businesses, particularly automakers. For instance, General Motors, GM, reported a staggering $1.1 billion hit from tariffs in just one quarter, with projections suggesting the annual cost could balloon to between $4 billion and $5 billion. Despite these challenges, GM has opted not to raise vehicle prices yet, even as its net income dropped by over 34% year-over-year in the second quarter. Meanwhile, Stellantis, owner of brands like Chrysler, Dodge, and Jeep, faced approximately $350 million in tariff-related expenses during the first half of the year. These numbers paint a grim picture for automakers' profitability. According to David Beery, a public policy professor at Virginia Tech, automakers are essentially subsidizing car buyers right now. Currently, automakers are eating the costs of tariffs, which is cutting into their profits, he explained. But that approach simply isn't sustainable in the long run. This raises an interesting point. If automakers can't sustain this financial burden indefinitely, who will ultimately foot the bill? Consumers, inevitably, seem poised to bear the brunt sooner or later. Aaron Keating, an executive analyst at Cox Automotive, described the upcoming months as the big squeeze. She predicted that the real story this summer would revolve around the growing gap between rising costs for manufacturers and dealers versus relatively stagnant consumer prices. Robert Fogarty, a Maryland-based car dealer, echoed this sentiment, noting a recent uptick in customers rushing to purchase vehicles out of fear that prices would soon climb due to tariffs. His dealerships saw a noticeable surge in April as buyers scrambled to lock in current pricing. While some companies are holding off on increasing prices, others aren't so hesitant. Take Bossard Group, a Swiss manufacturer of fasteners operating globally. Its CEO, Daniel Bossard, announced plans to pass along significant price hikes, ranging from 10 to 30%, to customers, acknowledging the difficulty of such a move. It's certainly not easy, he admitted during a call with analysts. Similarly, Halliburton, a major oil services provider, cited tariffs as a factor in reducing its second quarter profits by $27 million. General Electric, GE, another industrial heavyweight, estimated that reciprocal tariffs could cost the company roughly $500 million in 2025. GE stated it would attempt to offset these losses through cost-cutting measures and strategic pricing adjustments. However, economists caution that it may still be too early for tariffs to fully manifest in consumer prices. Many businesses stocked up on inventory earlier this year in anticipation of tariff-related impacts, while other goods were already in transit when the levies took effect. Additionally, some firms may be reluctant to raise prices further, fearing backlash from inflation-weary consumers. Uncertainty surrounding the permanence of these tariffs adds another layer of complexity. Some economists suggest that companies are also wary of provoking political backlash, particularly given former President Trump's vocal stance on keeping prices low despite imposing hefty duties. As Justin Wolfers, an economics professor at the University of Michigan, put it, he's talking directly to the companies. He's telling them what to do. So, where does this leave automakers and other industries grappling with tariffs? Industry observers believe it's unlikely that automakers will increase prices by the full 25% levied on foreign-made vehicles, as such a drastic hike would alienate buyers. Ivan Drury, director of insights at Edmunds, pointed out that the average manufacturer-suggested retail price for cars was already $50,000 in June. A $10,000 bump in MSRPs, he argued, would effectively kill sales. Instead, automakers may tie new tariff-related costs to added features when rolling out 2026 models, softening the blow for consumers. Francesco Bianchi, an economics professor at Johns Hopkins University, offered another perspective. Since cars are durable goods, often ranking among a household's largest expenditures, families can delay purchases if prices become prohibitive. This reality may make automakers more willing to absorb temporary profit hits rather than risk losing customers altogether. But here's where it gets controversial. Is absorbing these costs truly in the best interest of companies, or are they merely postponing an inevitable reckoning? And what about the broader economic implications? Could these tariffs lead to unintended consequences, such as stifling innovation or driving jobs overseas? These questions deserve deeper exploration, and your thoughts matter. Do you think companies are making the right call by shielding consumers from immediate price increases? Or is this just delaying the inevitable? Share your take in the comments below. How Trump's tariffs impact American consumers and businesses. Imagine this. Every time you buy a car, a toy, or even a simple appliance, you're indirectly footing the bill for someone else's political games. That's right. Americans have been the ones shouldering the burden of Trump's tariffs, and it's a story that's far from over. Let's dive into the details and see how this economic maneuver is playing out in the real world. But here's where it gets controversial. While some argue that these tariffs are a necessary evil to protect American industries, others see them as a misguided policy that's hurting the very people it aims to help. And this is the part most people miss. The true cost of these tariffs is being absorbed by everyday consumers and businesses, often in ways that aren't immediately obvious. So, who's really paying for Trump's tariffs? The answer might surprise you. General Motors, one of the largest automakers in the United States, recently disclosed that the tariffs have taken a significant bite out of their profits. In a stunning revelation, GM announced that the duties have raised their costs by over $1 billion, a figure that highlights the substantial impact these tariffs are having on major corporations. But why didn't car prices skyrocket in the latest inflation data? The answer lies in how companies like GM are choosing to absorb some of the costs rather than passing them entirely onto consumers. This strategy, while beneficial in the short term, raises questions about sustainability and long-term financial health. Meanwhile, other commonly imported goods like toys and appliances have seen robust price increases, indicating that the tariff expenses are indeed being passed on to consumers. This discrepancy raises an important question. Is the burden of these tariffs being distributed fairly? GM's financial report paints a grim picture. The automaker reported a profit of $2.53 per share on an adjusted basis, which, while above the Bloomberg consensus forecast of $2.33, is still significantly lower than the $3.06 it made a year ago. This decline in profits underscores the severe impact of the tariffs on the company's bottom line. But here's where it gets even more interesting. GM has revealed no immediate plans to return to pre-tariff profit levels. This lack of a clear strategy raises concerns about the company's ability to navigate the current economic landscape and adapt to the ongoing trade war. So what does all this mean for the average American consumer? It means that every time you buy a product that's subject to these tariffs, you're paying a little more than you should be. And it means that companies like GM are struggling to stay afloat in an increasingly uncertain market. But here's the million-dollar question. Are these tariffs worth the cost? Some argue that they are a necessary step to protect American industries from foreign competition. Others see them as a misguided policy that's hurting the very people it aims to help. What do you think? Are Trump's tariffs a necessary evil, or are they doing more harm than good? Share your thoughts in the comments below, and let's start a conversation about the true cost of these economic policies.